Hey everyone, welcome back to Chipstock Investor. I'm Kasey,
Hello, I'm Nick.
and we're going to be talking about some exciting stuff today.
Super exciting. Tariffs. Hey, we got good news. We got tariff exemptions on chips over the weekend.
Oh, wait.
Uh,
No, we don't. It's a
Well,
very short time period.
yeah, we have a very short window of exemptions. And actually, we'll get to that. That's our first key point.
Yeah, we'll talk about how long will those exemptions last? Are we headed for another bear market again? And there's nowhere to hide, so strengthen your mind and fortify your emotions. If you haven't yet, please watch that video on your mindset in investing. We'll link that right here.
Yeah, and for more info like this and the complete body of work, check out Semiconductor Insider. We are actually running a 25% off sale on the annual membership. Link to that below, or you can try it for just a single month.
Let's focus on that supply chain exemption list. Nick, break it down for us.
Okay, this was the good news that we got over the weekend. A little bit of reprieve for the semiconductor industry and the electronic supply chain overall when the US Customs and Border Protection provided some updated guidance on reciprocal tariff exclusion. So this is the higher tariff rate. Now, the 20% baseline tariffs on everything are still very much in force, even on these products on this list. But the higher reciprocal rate, like what are we up to? 125, 145% tariffs between the US and China now. By the time these words come out of my mouth, there will probably be a higher tariff rate that's been announced that I'm not aware of. That is being currently excluded. And basically, what this is exempting from the US tariffs are things like PCs, smartphones, individual chips, flat panel displays, other integrated circuits and parts, as well as the actual equipment used to manufacture all of this stuff. So that's the good news here from this list. However, the bad news, Kasey, as you alluded to, is this isn't going to be good for very long, supposedly.
It's possible that by the time you watch this video, those exemptions have been tossed out the window. The administration in the United States has stated that these exemptions are coming to an end later this week.
What those new tariffs on the electronic supply chain actually mean, we'll find out later this week. Again, check out Semiconductor Insider, where we'll be updating everybody throughout this week, including 2 live events. Those live events cover everything from live Q&A, where you can ask Kasey and I about our research process, what we're investing in, and most importantly, why. And we'll also be having some live presentations on different companies and topics in semiconductors and just investing in general. Check it out. Sale running through the end of April.
We've been receiving a lot of questions and some discussion about how we're headed for a bear market. But one thing is important to remember, specifically about the semiconductor industry. This chart right here, everything not accelerated compute, including consumer, cloud and enterprise, and auto and industrial, has been in quite the downturn for the past few years. Auto and industrial has been hit the hardest and the longest, still at the very bottom. But these other end markets, cloud and enterprise, consumer, just starting in that growth cycle.
So for those of you that think the semiconductor industry is headed for another steep downturn, we think what you probably mean is accelerated computing and NVIDIA. I think that's probably what these folks are alluding to. As far as the semiconductor industry overall goes, we have not really had great, fantastic times for a while now. As you said, it's been a few years, at least since the chip shortage came to an end in 2022, early 2023. But let's just break down a few of these points. This was something we addressed over on Semi Insider, and we'll use a couple of charts from our friends over at finchat.io.
Finchat.io is the sponsor of today's video, and you'll see their charts in almost all of our videos and a lot of our research. We use their charts specifically for things like this, breaking down geographies, revenues for companies so that we can analyze the business.
There are a lot of other great features on FinChat, including a co-pilot that allows you to have a conversation with the AI built into FinChat to help you get a better understanding of the business or the industry that you're trying to figure out and decide whether or not it meets your criteria as a good investment.
You can try FinChat for free, but if you'd like any of their paid plans, check out our 15% discount. FinChat.io/CSI gets you 15% off. We'll link that in the description below. FinChat.io/CSI. One of the biggest arguments that we see is that China was such a big part of the revenue stream for a lot of these companies, specifically the fab equipment suppliers like ASML or Applied Materials. In fact, China could have been up to 40 to 50% of some of these companies' revenue.
You can see that here in this chart. This is for ASML. The orange bar is the company's total revenue. The dark blue bar is specifically revenue from their customers in China. And then the blue line is the percentage of revenue coming from China. Now, here's what happened in the aftermath of the pandemic when we had supply chains getting disrupted the first time. This is about to happen again, probably. But what happened was there was a big backlog of orders from China during that chip shortage. And companies like ASML didn't really get around to those orders until the last 2 years. And that's the big spike in revenue from China. That is already starting to normalize, and we should fully expect this percentage to go back to the historical norm of maybe about 20% of total ASML revenue, excluding any really out of left field tariffs or restrictions coming out in the coming weeks.
And it was a similar story for Applied Materials. Same breakdown in this chart. China revenue in blue, Applied Materials total revenue in orange, and then the percentage of that China revenue in the blue line. Applied Materials also sold plenty of equipment during this time when China could buy it and stockpile the equipment. This brings up another argument that we've heard, that domestic companies in China are developing their own equipment now. They won't have to be buying from companies like Applied Materials or ASML. While this is true, this isn't a new problem that these companies have. Some of the companies in China have started to compete with the Fab Five, but competing is just a natural part of the process. It's not bad in and of itself. It keeps the big semi-caps honest.
Competition actually is a good thing. It ensures that companies like ASML and Applied Materials keep innovating so that their customers get benefit from what they do and keep purchasing equipment from ASML and Applied Materials. Competition oftentimes gets overstated as a risk. Competition is actually a fantastic element of investing. So just because China is starting to compete, perhaps more than they have in the past, doesn't mean they're automatically going to land a sale and ASML and Applied Materials and the other semi-caps lose out. It's not an automatic given. This is really expensive equipment. It has to fit with the current processes used to manufacture chips and piece together electronics. And speaking of the semi-cap companies, this leads us to another argument we've been hearing as to why we're headed for another bear market for the semiconductor industry. Some of the biggest manufacturers are declining customers for the semi-caps, for the Fab Five.
Maybe you're thinking about Intel, for instance, one of the biggest IDMs, the purchaser of fab equipment, but there are so many more. Intel has not been doing great for almost a decade now, and Samsung has had some significant woes as well. But those two companies are not the only businesses that are buying fab equipment. There's plenty of other foundries as well. Here's just a few more examples of other foundries besides Taiwan Semiconductor.
Yeah, and of course, at the expense of Intel and Samsung Foundry, TSMC is mopping up and then some. And really, even within the IDM space, the integrated device manufacturer space, Intel is not the end-all be-all of the semiconductor industry. It hasn't been for a long time. There are some other very large IDMs like Micron, Samsung, and SK Hynix. We just did our memory chip segment of the semiconductor industry flow last week. We'll link that as well here in the video. Texas Instruments is still very much a giant company in the IDM space. Even Broadcom and Qualcomm, as we explained a couple of years ago, do have a bit of manufacturing capacity still. And then back to the memory chip IDMs, we actually had a couple of memory chip IPOs at the end of 2024, Kioxia and SanDisk. There are a lot of companies in this IDM space besides Intel that need lots of equipment. And then, of course, we're not even getting into the different IDMs that make logic chips, microcontrollers, other processors, lots of companies in Europe and Japan that participate in this market. And then the analog and power chips and sensor segment, very long list of companies that need manufacturing equipment that sell chips. So this argument that Intel and Samsung are not doing so right now, that they're in decline, TSMC can't possibly buy enough equipment to keep the industry out of a slump, just really doesn't hold much water, because the industry has been fine the last 2 or 3 years, as we've already been in a pretty significant downturn already. And up to this point, before the tariff curveball got thrown at us, everything was okay. And we still think we're actually going to be okay. So maybe we should segue into our last point: cultivating good investment habits if we are indeed headed for another bear market, our third one in 5 years.
This is a good place to talk about diversifying your portfolio. Manufacturing industries, of course, do have an above average cycle. However, all industries go through some form of cyclicality. This is why it's so important to diversify your portfolio away from different end markets, different sectors of the economy, so that maybe when one is going through a cycle, another one can pick up some slack. Of course, that's a little bit more difficult when the entire market is going through a downturn.
Yeah, some much needed clarity on what is happening with the trade war will certainly help. Diversification doesn't save you from when the market kind of across the board gets hit. So this is where fortifying not just your mindset and your habits, but also your emotions comes into play. Really important here to just take a step back and remember that, as uncomfortable as this may be, periods of downturn are a normal part of how the market functions and how it works. And we'll reiterate a really important point here from our mindset video last week. If you are not a net saver, quarterly, monthly, or whatever, right now is a fantastic time to tighten up your belt, your personal budget, and figure out how to get money into your account on a regular basis. That way you have the cash to be able to go buy some of these businesses while they are dirt cheap. I don't think we need to say this is like some sort of a generational buying opportunity, because we've now had two of those already in the last 5 years, but let's just call it what it is. If you have a long-term horizon for investing, you can buy quality businesses and sit on them for many years or for the indefinite future. You want more cash getting into your account so that you can purchase when stuff is on sale.
Thanks, everybody, for watching this episode of Chipstock Investor. Make sure you check out the Semi Insider membership, link in the description below for that annual sale. Make sure you hit the subscribe button. We'll see you all again very soon at Chipstock Investor.